Welcome to my channel. I'm Doris and I'm here to share with you about my stock account update. Today my stock account lost a total of $915 US. US stocks rose 3 consecutive gains and the vision of a soft landing on several US PMI indicators kept below the line between expansion and contraction is fading. So let's take a look at my account. Right now, the net asset of my account is $79,665.89. Today, including the aftermarket, I've lost $152 or 0.19. I've gained $152 and that's a gain of 0.19%. But in total, I still lost $21,515.57. Today, SQQQ increased by 0.69% to 42.13, and the DRV decreased by 1.02% to $43.61. And looking at the market today, market showing an even between increase and the lost stocks. Dow Jones Industrial Average increased by 0.31% to $33,733.96. Nasdaq Composite decreased by 0.27% to 11,334.27. S&P 500 decreased by 0.07% to $4,016.95. And the industries, the diagnostics and the research ETF decreased the most by 2.55%, and then internet and the software all decreased by more than 1%, as well as oil and gas. The aerospace and defense increased by 1.49%. U.S. stocks closed mixed Tuesday, with the Dow up for a third straight session. The market measures the state of U.S. economy and continued to weigh the Fed's monetary policy outlook. Economic data showed U.S. business activity contracted for 7 straight months. The Dow closed up 104.4 points, or 0.31%. The Nasdaq fell 30.14 points, or 0.27%, and S&P 500 fell 2.63686 points, or 0.07%. The New York Stock Exchange glitched down early Tuesday, with many stocks briefly suspended before normal trading soon resumed. Major stocks affected including Morgan Stanley, Verizon, AT&T, Nike, and McDonald's, among others. Many stocks show unusually large swings at the opening time, which may have triggered circuit breakers. The New York Stock Exchange said around 9:50 a.m. Eastern Time that all of its systems were operating normally. U.S. stocks closed higher on Monday, with all 3 major indexes rising for a second straight session, with the Nasdaq and the S&P 500 hitting their highest close in 7 weeks. Despite Monday's gains, many expect the rally to fade, given the lackluster start to the earnings season and more signs that the economy is slowing. Chief Investment Officer at UBS Global Wealth Management said, "We don't see much room for gains in the near term, especially because we forecast continued pressure on corporate earnings growth. The company now has S&P 500 price target of 3,700 for June and for 4,000 for December, while the S&P 500 closed Monday at 4,019.81. New Edge Wealth Company Chief Investment Officer Cameron Dawson said the U.S. rally on Monday was not a real rebound. Only the S&P 500 breaking above the key 4,100 level, 65-day high, could suggest that the rally could enter a new bull cycle. She warns that the upside could be limited before the Fed turns fully and stimulates the economy again. On Tuesday, U.S. business activity contracted for 7 straight months, but at a more moderate pace, with stronger measures of input prices indicating lingering inflationary pressures. The S&P 500's index PMI rose 1.6 points to 46.6 in January. Standard & Poor's reported Tuesday the input price index has climbed for the first time since May, while the first recovery in the composite PMI in 4 months suggesting a slowdown in industry contraction. The rising price index reflects companies still facing higher labor and some material costs. The Fed's aggressive action to reduce inflation are starting to spread across the economy, with rising borrowing costs helping to curb demand. The S&P Global Composite Index showed orders shrinking for the fourth consecutive month. Among overseas central banks, European Central Bank President Christine Lagarde said on Tuesday that it will raise interest rates sharply at its next meeting and that the European Central Bank will stick to its 2% inflation target. She said the ECB would take everything necessary to bring inflation back to the target, noting further significant rate increases at upcoming meeting. She said borrowing costs must rise steadily to reach enough restrictive levels and remain there for the time needed. Her comments sparked heated debate on whether it is appropriate to slow the pace of rate hikes as inflation retreated from record highs. She said last week that sticking to the line was her policy mantra, as officials increasingly shifted from general inflation to record core inflation. She said although energy inflation has fallen recently, underlying inflation continues to rise. The U.S. Manufacturing and Services Purchasing Manager Index PMI both rebounded slightly in January, shortly after the market opened on Tuesday, but both indicators remained below the line between expansion and contraction. Specific data shows that U.S. manufacturing PMI shows slightly to 46.8 in January from 46.2 last month, while the Service Business Activity Index Services PMI rose slightly to 46.6 from 44.7 last month, better than market expectations of 46.5 and 45, respectively. That brought the Composite PMI Outlook Index Composite PMI preliminary reading to 46.6 in January, up 1.6 points from 45 in December 2022, and stronger than expectations of 46.4. This is the chart of S&P Global Flash US PMI Composite Output Index. We can see that it decreased after the financial crisis in 2008 and the COVID pandemic after 2020. And recently, it has shown a consistent trend of decreasing. At the same time, we can see a relative direct relationship with U.S. GDP, and since it is decreasing, then many market analysts are expecting that the GDP will fall at the same time as S&P Global U.S. Composite PMI. While the data were stronger than expected, Chris Williamson, chief business economist at S&P Global Market Intelligence, wrote of another sharp contraction in business activity in January, indicating that U.S. economy remained disappointing at a weak start to 2023. He added that despite a slight improvement from December, activity in both manufacturing and services have declined, one of the biggest declines since 2008 global financial crisis. In horizontal comparison, the S&P's January composite PMI for Japan and the Eurozone has recovered above 50 line, which could mean the U.S. recovery is slower than the two regions. Williamson also noted that the U.S. jobs growth has also cooled, was much weaker in January than in much of last year, reflecting corporate hesitation to expand capacity amid uncertain trading environment in the coming months. Despite the improvements in corporate confidence, the overall level of confidence remained low by historical standards. He also stressed that he also saw inflation on input costs rising faster in the new year, partly because rising wages, which is very worrying. While the risk of a recession is rising, it could encourage the Fed to tighten monetary policy further aggressively. What is clear is that This is not a soft landing previously claimed by central banks officials, but more of a precursor to stagflation, with the prospect of high unemployment and high inflation, hoping for the Fed to abandon the economy as soon as possible. After the data, 2-year Treasury yields related to economic expectations hit a one-week high after the data, while 10-year yields also rose significantly. Meanwhile, the dollar index jumped 30 points to 102.44, while the USD Japan jumped 70 points to 131.11. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.